Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special conversation that we're going to be having with Max Healthcare, that the company has reported Q2 numbers with its revenue surging by 21% year on year to coming in at 2,692 odd crore rupees. We've also seen that operationally the company has done better. The operating EBITDA has grown to 694 odd crore rupees, a 23% jump from last year, same quarter. The profitability also, along with the favorable tax impact, we've seen a 59% year-on-year growth to 554 crore rupees as well. The operating margins have inched up to 26.9% from 26.6% in Q2 of FY25. We've also seen bed occupancy for the quarter at 77% and the ARPOB now at 77.3 thousand odd rupees as well. So let's in fact welcome the top management of Max Healthcare to give us an understanding of what all has contributed in this quarterly earnings and what's the outlook going forward. Let's welcome Mr. Abhay Soi, the Chairman and Managing Director of Max Healthcare, to join in on the program with us. Warm welcome to you, sir, and thank you so much for taking the time out. Always a pleasure to have you with us, and I'll start off by congratulating you. Again, a strong, steady quarter that you have reported this time. Would you be able to give us the key driving factors behind the growth that you posted this time, sir?
I think clearly the key driving factors has been growth of our pre-existing facilities, which grew by about 13 to 14%. As well as the capacity addition we've done over the last 15 months, which is close to about 1,500 beds, which is 30% of overall capacity. I think all of that sort of kicking in has led to the kind of numbers that we've seen. Although having said that, it's not something which was entirely unexpected by us or by the street. You had a sort of consensus was slightly lower than these numbers. We, of course, outperformed it by a bit, but yes, not such a significant amount that it's come as a surprise or anything like that.
Absolutely. So if you could just help us understand, when it comes to the occupancy, it was at 77%. How do you see it panning out in H2 as well? And would you also be able to give us some insight into, largely it would deal with Q3, but any signs of in the Delhi NCR region, pollution-linked occupancies that you've actually seen, and if there is an uptick year on year on that as well?
Well, it's difficult to sort of look at, so we haven't had any significant pollution-linked occupancies. Actually, this year we have not had the seasonal flus as well. As you're aware, monsoons kind of graduated into winter straight away. So, there wasn't the kind of climate which is there usually for mosquitoes, etc. So I think it was one of the positives is that perhaps the seasonal surge in occupancy wasn't there because the diseases wasn't there. I think so. That's one. Having said that, we are going to the drivers going forward will be the, I won't say occupancies, but occupied bed days, because, although occupancy levels are 77%, we will be rolling out significant amount of capacities in the coming quarter itself. Just a few weeks ago, we rolled out 168 beds in Mohali in Punjab. Over the next couple of days, we will be rolling out another 270 beds in Mumbai at Max Nanavati, as well as within 30 days, we will be rolling out about 400 beds in Max Saket, which is Max Smart at Saket. So that's a significant capacity expansion. Before the end of the year, an additional 150 beds in Lucknow, as well as the greenfield capacity at the end of the year of 500 beds at Gurgaon. So you're seeing another 1,500 beds come through. So I think more than sort of occupancy levels, the occupied bed days would be the thing to look out for.
Absolutely. And sir, if you could just give us what are you at when it comes to the number of beds, and with all these additions by the end of FY26, where will we be at?
So I think as we speak, we are about 5,100 beds, and by the end of the financial year, we'll be 6,500 beds.
6,500 beds. And when we talk about the kind of, creating capacities that you're talking about, how are you, right now placed, and how many beds are operational as of now? Going forward with this CapEx, what are you looking at, sir?
So, do keep in mind, last year we were 3,500 beds.
Yeah.
This year, as we speak, we have 5,000 plus beds and moving up to 6,500 beds. So it's a capacity increase of 30% last year, another capacity increase of 30% this year. In
Right.
spite of that, the overall occupancy levels, okay, have been constant. Although, they're 77, 76%, which is pretty much as close to sort of full. These are midnight occupancies, right? In a
Right.
hospital, what it means is if you take out the Sundays, because I mean, of course, even doctors need that one day off from
Yes.
surgeries. And if you take out public holidays, and this is midnight occupancy. That means all the admissions in ER at night kind of balloon up occupancy. So typically, when it's 77 or 80% at night, it is close to 100 or exceeds 100% by 12 o'clock during the day. So the only way around it is to increase sort of capacity, and this is exactly what we're doing going forward as well.
So your average revenue per bed is now almost at 77.3 thousand rupees. So how are you looking at? Is there any scope to increase this further going forward from here? How are you looking at this metric also?
So I think the older mature hospitals, which were there pre-December, let's say 24, they've also grown at about, I think, 7 to 8% RPOB, which is in line with what the RPOB growth has been for some time now. You must keep in mind that this RPOB growth is really constitutes three things: the patient mix improvement, the clinical mix improvement, as well as inflation. Medical inflation is typically 2 to 3%, which 2 to 3% sits as a part of the 7 to 8% RPOB increase. That was as far as mature hospitals are concerned. If then we added, like I said, plenty of hospitals over the last 18 months, including these hospitals. The growth has been 1%, but I exclude these hospitals, then I think the growth is going to be about 3% odd. So I think, so it's been a reasonable and in line growth. Keep in mind that some of these hospitals, which have been over the last 1 year, which have been in tier 2 cities, particularly Lucknow, Nagpur, as well as the new hospital, Greenfield at Dwarka, which was put up, operate at lower RPOBs. So that has the overall sort of this thing of bringing the RPOB down. But really, that is not what the consideration is. Consideration for us is, even if we enter in tier 2, tier 3 cities, it should have a significant or non-dilutive and accretive return on capital employed.
Absolutely. So, just to get an understanding, I know that the GST rationalization was just brought in by the fag end of September, and it would hardly be seen in this quarter, more likely in Q3 and Q4. Help me understand, has the GST 2.0 rollout really led to any meaningful affordability or creating easier, prices as far as healthcare is concerned, hospitals are concerned? You did talk about the medical inflation. Has it been able to curb some of that aspect for patients?
I think the GST reduction has been with the medical insurance sector and not so for the hospital sector. Although it has impacted the MRP of the selling price of medicines, which has come down to the extent of GST. So there will be 3 to 4% impact. Typically a hospital healthcare becomes cheaper by 3 to 4%. But having said that, like I said, medical inflation historically has not been more than 3%. So it's not a very, very egregious number. It's perhaps equal to or lower than even CPI.
Absolutely. Now, I wanted to also understand, sir, if you could give us an understanding of both your international business vis-a-vis domestic business as to how they are contributing, and going forward from here, how do you see both these aspects growing for second half, sir?
Well, both have been growing. We've seen international business grow by 25% this quarter, year on year. Last quarter, year on year, it was an increase of 30%. But like I said, our occupied bed days have also gone up by 30% because our capacity has gone up by 30%. So although it's an extremely, extremely strong growth number on international business, I think somewhere it gets obfuscated by the fact that everything else is growing at a fast pace as well. Having said that, I think we're happy with this growth rate, and we believe, given the significant comparative advantage India has, this number should continue going forward as well.
Okay. When we talk about your, Max Lab as well as Max at Home, how was the contribution from these segments in the quarter, and how do you see the growth panning out for these two segments for you going forward, sir?
I think they've grown by about 20 and 18% respectively. Historically, they've grown at anything around 20% and plus. Of course, quarter on quarter, it's always a plus minus 1 or 2%. So it's had a healthy growth. I think one is growing has a EBITDA margin of 24-25%. The other has a EBITDA margin of 16-17%. But like I said, mentioned, these are both growth businesses. These margins exist because of the investments we are making in these businesses. Having said that, they're ramping up at a good pace, but so is the rest of the business as well, right?
Okay. So if you could just help us understand what's the broad trend between tier 1, tier 2, tier 3 cities, what are the kind of capacities that are creating more growth for you, at least at the current space?
I think a large part of our growth is coming through brownfields. So you're seeing about almost 75% of our growth coming from brownfields. And because historically we've been present in tier one cities, and growth coming from brownfields is also leading to a higher amount of growth coming in tier one cities compared to tier two. Having said that, we see opportunity in tier two cities, particularly with respect to new build-outs, greenfields, etc. Because quality facilities don't sort of exist in tier two, tier three cities. They need to be created. It is the need of the hour. It is the need of decades to come. You have to be able to meet the requirements, perhaps a decade later of the aspirational India, a lot more than we will need to today. But we need to plant the seeds as we speak. We need to build out those capacities in places where you would need them in years to come. And those are tier 2, tier 3 cities as well.
Right. Any more strategic acquisition on the cards, sir, especially when it comes to the inorganic route? What are you exploring, sir? Anything that could happen in the rest of FY26?
Well, hopefully a lot can happen in the rest of FY6. We did 3 acquisitions last year.
Yes.
So far this year, I don't think we've been fortunate as far as long pipeline, a lot of stickiness with it. We've sort of rolled out many build-to-suits and acquisitions of lands, etc. this year. But when it comes to operating assets, hopefully, something should come through in the quarters to come.
Okay. So could you give us a broad idea as to, everybody is going big on digital space, so digital healthcare apps, digital delivery. How are you looking at these tech-enabled spaces for you, and, where does it augur in your own broad vision?
So I think, clearly the consumer buying behavior has changed. At present, 30% of our revenues are coming through bookings or through these things on digital media. And that is going to be the way to go going forward as well. I mean, of course, you can't deliver healthcare, at least the surgical part of it, etc., through digital means. You can only take bookings. You can, of course, we are moving digital as well as AI to the core of what we do for predictive analysis, not only and for logistics and occupancies and discharges and so on and so forth. And of course for diagnostics as well. But when it comes to tertiary care, I think or clinical programs, then it's still a while to go. Although as far as bookings are concerned, and like I said, logistics are concerned, we've seen the advent of digital technology.
Okay. So if you could give us, the top 3 key growth drivers for you going forward, what would those be, sir, which could help you consistently build up on the growth that you have charted so far, and that could probably broaden your horizons as well, sir?
So I think, capacity is by far, because of the sheer shortage of capacity that we have, capacity infrastructure build out is perhaps by far the biggest lever for us. Having said that, the clinical mix towards more sort of higher end programs is the second, second lever that we're looking at, and third would be, in my mind, international business. So I think focus on international business should be able to help us drive numbers as well.
Okay. Give us a sense, sir, by the end of the year, what do you end with in terms of your growth on top line, on bottom line, as well as on the operating margins front, sir?
So, I stay away from giving any guidances on top line, middle line, or bottom line. And so fear you're not going to be so lucky on that from my end. But yeah, I think capacity addition, like I said, 30% last year, 30% this year, increase in occupied bed days of 30%. So that's a very, very strong growth path we are on, and no reason for that not to continue.
Absolutely. Well, always a pleasure to have you with us, Mr. Soi. Thank you so much for speaking to us and sharing all these insights. I wish you all the very best for the upcoming quarters. And of course, we will be speaking to you yet again on your vision going forward. Thank you so much.
That is just mine, Sakshi. Thank you.
Thank you so much. All right, viewers, I hope that you enjoyed this conversation with Mr. Abhay Soi, the Chairman and Managing Director of Max Healthcare, as he detailed for us how capacity and focus on building more capacities, increasing the number of beds, increasing ARPOB is going to be, of course, of importance to the company, and how they are going to be consistently at the growth path going forward from here. The kind of insights that is shared on top line, bottom line, as well as in the operating figures as well. A lot of those expansion plans, inorganic route expectations that are also lined up. So we may be able to hear a lot more on the inorganic route as well from the company in this year itself. With that, we wrap up this special earnings conversation. Stay tuned with us on Business Today Television. There's a lot more lined up for you to really look at from the world of business and finance.